The shock that is coming out of Iran is not just a headline. It is not just another geopolitical story that people argue about for 2 days and then forget. It is a pressure point in the system. And when a pressure point gets hit in the wrong place, the effects do not stay in one place. They move through oil, they move through inflation, they move through interest rates, they move through jobs, they move through corporate earnings, they move through portfolios. That is why I am paying attention. Most people will look at this and see fear. They will see oil prices rising, they will see television anchors shouting, they will see markets falling, and they will feel the impulse to do exactly the wrong thing at exactly the wrong time. A smaller group will understand the machine. They will understand that chaos does not destroy wealth by itself. Chaos transfers wealth from people who do not understand cycles to people who do. It transfers wealth from people who react emotionally to people who prepare logically. It transfers wealth from people who chase noise to people who study cause and effect. That is the difference. When oil prices go up, the effect is not isolated to oil companies. Oil is an input into almost everything. It affects transportation, it affects manufacturing, it affects shipping, it affects the cost of food, it affects the cost of goods, it affects how people feel every time they open their wallet. When the price of energy rises sharply, inflation pressure comes back into the system. When inflation pressure comes back, the central bank has less room to help. That is the part most people miss. If the economy is weak and inflation is low, the Federal Reserve can cut rates, it can ease conditions, it can try to support demand. But when the economy is weak and inflation is rising, the central bank is trapped. If it cuts too aggressively, it risks making inflation worse. If it does not cut, it risks letting the weakness spread. That is the basic pattern of stagflation. It is one of the hardest environments for ordinary investors to understand because the normal playbook stops working. Bad growth would usually be solved with easier money. Bad inflation would usually be solved with tighter money. But when both happen at the same time, the system has a conflict inside it, and conflict inside a system creates volatility. This is why investors get wiped out. They do not get wiped out because there is bad news. There is always bad news. They get wiped out because they do not understand what kind of bad news it is, where it travels next, and what it does to different assets, different companies, and different cash flows. The Iran shock matters because it can push oil higher. Higher oil can push inflation higher. Higher inflation can keep rates higher than people expect. Higher rates can pressure consumers, businesses, and valuations. And when that pressure spreads, the weak parts of the system start breaking. That is the chain. You do not have to be afraid of the chain, but you do have to understand it. The market has gone through this many times before. It has gone through wars, recessions, crashes, pandemics, inflation shocks, banking stress, technology bubbles, debt problems, and political shocks. The names change, the headlines change, the emotional intensity changes, but the pattern is very old. The market moves in cycles. There are expansions, there are bubbles, there are contractions, there are crashes, there are recoveries. Then people forget the lessons and do it again. That is human nature. Every cycle feels new to the person living through it. But when you study enough history, you begin to see that the causes may change while the behavior stays remarkably similar. People become greedy near the top. They become fearful near the bottom. They confuse price movement with truth. They confuse volatility with risk. They confuse news with understanding. I have learned that a crash is not automatically a disaster for a prepared investor. A crash is a test. It tests your liquidity. It tests your temperament. It tests the quality of the companies you own. It tests whether you bought an asset because you understood its economic engine or because somebody else said it was going up. The investors who suffer most during a shock are usually the ones who built their portfolios for a world where nothing goes wrong. The investors who do best are the ones who understand that something always goes wrong. That is not pessimism, that is realism. The world is a machine with many moving parts. Oil, inflation, rates, employment, margins, debt, liquidity, supply chains, capital spending, and investor psychology are all connected. If you pull hard enough on one part of the machine, another part moves. So when I look at a potential oil shock, I do not simply ask, should I buy oil? That is too narrow. Oil can go up, oil can go down, oil is cyclical, it can make dramatic moves over 3 months, 6 months, or a year. But I am not interested in building a long-term portfolio around a commodity that moves with a cycle I cannot control. I am not trying to trade every spike. I am trying to own the types of businesses that can come out of the volatility stronger. That is the key distinction. A trader asks, what will move next week? An investor asks, what will become more important over the next decade? Those are completely different questions. They produce completely different portfolios. They also produce completely different emotional experiences. If you chase oil after oil has already spiked, you may be right for a while, but then you have to be right again about when to sell. Then you have to be right again about where to put the money. That is not a system I like. I prefer systems where time is my ally. The better question is this: if the world becomes more unstable, if energy becomes more important, if AI keeps demanding more power, if companies need more automation, if geopolitical risk keeps disrupting supply chains, which businesses become more essential, that is where the opportunity is. Not in panic, not in hiding, not in going all cash. Cash can feel safe during a crash. It gives you emotional comfort. But over a long period of time, inflation attacks cash quietly. It does not create a dramatic headline every morning. It just reduces what your money can buy. Over the last quarter century, the dollar lost a very large portion of its purchasing power. Many people felt safe because the number in the bank did not fall. But the purchasing power behind that number was being eaten year after year. That is a silent loss. A market crash is visible. Inflation is often invisible until it is too late. This is why I do not think the answer is to run entirely into cash. Cash has a purpose. It gives you optionality. It helps you buy when others are forced to sell. But cash is not a long-term wealth building machine, nor do I think the answer is to blindly buy defense contractors just because there is geopolitical stress. Defense companies may benefit during certain periods. Defensive stocks may hold up during certain periods. Consumer staples, healthcare, and telecom may give investors comfort in a crisis. But comfort and long-term compounding are not always the same thing. The goal is not merely to survive the headline. The goal is to own the businesses that can compound after the headline is gone. That is how generational wealth is made. Great companies get pressured in a broad sell-off. The whole market throws them into the same basket as weak companies. The price falls because liquidity disappears and fear rises. But if the business itself remains strong, if the cash flows remain durable, if the market opportunity remains large, the recovery can create extraordinary returns. Amazon is a useful example because it survived more than one major crisis. During the dot-com crash, many internet companies disappeared. Amazon was punished badly, but it survived. During the financial crisis, it was punished again, but it survived. The key word is survival. A great business that survives a crisis often emerges with less competition, a stronger position, and a longer runway. That is what I look for. I do not want weak businesses that look cheap. I want strong businesses that temporarily become cheap because the whole system is scared. There is a very big difference. Weak businesses can go from cheap to cheaper to gone. Strong businesses can go from expensive to reasonable to compounding machines if you buy them with discipline. So when I think about an Iran shock, I am not thinking like someone trying to guess tomorrow's candle. I am thinking in sleeves. A portfolio should have a structure. It should not be a pile of exciting tickers. It should answer the question, what major forces are shaping the next decade, and which companies are positioned in the most essential parts of those forces. The first force is energy. AI is the most power-hungry technological wave we have ever seen. Data centers need enormous amounts of electricity. Cooling systems need power, chips need power, the grid needs capacity. The entire infrastructure layer behind AI is not virtual. It is physical, it requires energy, equipment, cooling, backup systems, and reliability. That is why energy must be part of the conversation, but I do not want energy exposure that depends only on oil going up. I want energy exposure that compounds with technology. I want businesses connected to the power needs of the AI cycle, not merely the commodity cycle. That is where companies like CGVRT and Bloom Energy become interesting in this framework. CG is tied to nuclear, VRT is tied to cooling and infrastructure, Bloom Energy is tied to on-site power production that is not fully dependent on the traditional grid. These are not the same as simply buying oil. They are related to the deeper question. How does the world power the AI supercycle when the existing grid is under pressure and geopolitical instability makes energy security more important? That question matters. If AI demand continues to rise, the need for reliable power will rise with it. If the grid struggles, the companies that help provide reliability, cooling, and on-site energy can become more important. If oil shocks increase the pressure on energy costs, the need for resilient infrastructure becomes more obvious. That is the kind of cause and effect chain I care about. The second force is memory. Most investors understand GPUs now because the market has already taught them to understand GPUs. But AI does not only need GPUs. As AI systems become more complex, as models use more context, as agents and superagents perform more tasks, The need for memory grows. A system that thinks more, stores more, retrieves more, and processes more requires more memory. That creates a bottleneck. And bottlenecks are important because in markets, the scarce part of the system often captures value. If demand rises faster than supply can respond, the companies that control the bottleneck can benefit. The memory market is highly concentrated. A small group of companies controls most of it in the framework of the source document. Micron stands out because it is the US-centered name in that group and because high bandwidth memory is directly connected to AI data center needs. That does not mean the stock goes up in a straight line. No important stock does. It means the business sits at a pressure point in the system. If AI complexity increases and memory demand rises, the companies providing that memory matter. If the market sells off because of a geopolitical shock, a strong memory company tied to AI infrastructure may become more attractive. Not less, provided the fundamentals continue to support the thesis. That is how I think the third force is production. AI is not just an idea. It has to be built, chips have to be designed, chips have to be manufactured, the machines that make the chips have to exist, the foundries have to operate, the connectivity has to work, the software layer that supports the design process has to function. This is the production sleeve NVIDIA and AMD address. The GPU side of the problem, ASML, is critical because lithography is one of the deepest bottlenecks in semiconductor manufacturing. TSMC is central because it manufactures the chips at scale. ARM and Cadence are connected to design. AET is connected to connectivity. This group matters in ordinary times. It matters even more when the world becomes chaotic. In a stable world, production efficiency creates advantage. In a chaotic world, production capability becomes strategic. Countries, companies, and investors all begin to understand that whoever controls the critical production layers controls more than profits. They control resilience. Geopolitical stress makes this more obvious. Supply chains are not abstract. They are physical and political. They depend on factories, ports, energy, rare equipment, and trust between countries. When trust goes down and volatility rises, mission-critical production becomes more valuable. That does not mean you buy every semiconductor stock at any price. It means you understand the map. If the market gives you a chance to buy the strongest parts of the production chain at materially better prices during panic, you should at least know what you are looking at before the panic begins. Preparation comes before opportunity. The fourth force is decision, making in chaos. This is where Palantir appears in this framework. In periods of uncertainty, the most valuable systems are the ones that help governments and companies see reality more clearly, connect data, make decisions, and act faster. When the world is predictable, decision systems are useful. When the world is chaotic, decision systems can become mission-critical. That is the logic. Palantir is framed as a company that helps organizations make decisions in complexity. CrowdStrike is framed similarly for cybersecurity. Datadog and MongoDB sit in the data, visibility, monitoring, and database layers. Oracle, Microsoft, Google, and Amazon sit in the broader database and cloud infrastructure layers. All of these businesses connect to the same broad idea. The more complex the world becomes, the more valuable the systems become that help people manage complexity. Chaos increases the need for visibility. Cyber risk increases the need for protection. Data growth increases the need for storage, monitoring, and access. AI increases the need for cloud infrastructure and decision platforms. Geopolitical stress increases the value of systems that can operate under uncertainty. This is why I do not look at these companies as isolated tickers. I look at them as parts of a system. Energy powers the system. Memory supports the system. Production builds the system. Data and decision software helps the system operate. Automation and productivity tools help the real economy adapt. That leads to the fifth force, automation and real-world productivity. If energy becomes expensive, if labor gets pressured, if supply chains become unstable, if inflation squeezes margins, companies must find ways to do more with less. That is productivity, that is automation, that is where the real economy meets technology. Tesla is connected to robotics and autonomous driving in this framework. Meta is connected to digital advertising becoming more efficient. Amazon is connected to AWS and its retail data advantage. SoFi is framed as a financial technology play, with Robinhood also added as an honorable mention. The common thread is productivity. Businesses that help people and companies operate more efficiently can become more valuable in a world where costs are rising. This is a basic principle. When pressure rises, efficiency becomes more important. When efficiency becomes more important, tools that improve productivity gain strategic value. Again, price matters. A great business bought at a terrible price can still produce a painful experience. A speculative business bought without a system can still damage a portfolio, but if the market gives you weakness in businesses tied to durable productivity trends, you should understand what you own and why you own it. That is the difference between panic buying and disciplined buying. The right companies are not enough. You also need the right system. This is where many investors fail. They make a list. The list may even contain excellent companies, but then they buy too much too fast, or they wait forever for the perfect bottom, or they use margin, or they sell during the first drawdown, or they confuse conviction with stubbornness. A watch list is not a strategy. A strategy defines how you buy, how much you buy, when you add, what role each position plays, how much risk you can tolerate, and what would make you change your mind. I believe in buying slowly. Slow buying protects you from your own ego. It recognizes that nobody knows the bottom. It gives you room to be early and wrong without being destroyed. It keeps you from turning a good long-term thesis into a bad short-term trade. If the shock comes and markets fall, the natural human impulse will be to either freeze or rush. Both are dangerous. Freezing can cause you to miss opportunity. Rushing can cause you to exhaust your cash before the real opportunity appears. The better approach is systematic. You build a core. The S&P 500 can be that core for many investors because it gives broad exposure to the productive capacity of major American businesses. Then you build around that core with carefully selected companies that represent the major forces you believe will matter. Over the next decade, you do not use margin, you do not borrow to buy volatility, you do not take debt to prove you have conviction. Leverage turns ordinary volatility into forced selling. It takes a temporary market decline and can make it permanent. If you are a long-term investor, forced selling is one of your biggest enemies. You also do not panic buy. Panic buying is the mirror image of panic selling. In both cases, emotion is driving the decision. The investor who panic sells is trying to stop pain. The investor who panic buys is trying to stop regret. Neither one is operating from principle. A principled investor plans before the price moves. That plan can include a DCA process where you buy in stages. It can include rules for adding when a stock falls by certain amounts. It can include a maximum position size. It can include a required review of fundamentals before each addition. It can include a distinction between core holdings and speculative holdings. The exact method is less important than the existence of the method. Without a method, the market will eventually find your weakness. If you are impatient, it will tempt you to chase. If you are fearful, it will tempt you to sell. If you are overconfident, it will tempt you to concentrate too much. If you are insecure, it will tempt you to copy someone else without understanding why. The market is very good at exposing people. That is why I focus on principles. The first principle is that crashes do not end strong portfolios by themselves. Inflation and bad behavior are usually more dangerous. A crash is painful. It can cut prices quickly. It can make the screen look terrible. But if you own strong businesses and you are not forced to sell, a crash can be temporary. Inflation, on the other hand, compounds against you every year, and bad behavior can destroy a portfolio at any time. The second principle is that revenue and profits matter over the long run. Narratives can dominate the short run. Fear can dominate the short run. Valuation arguments can dominate the short run. Insider selling headlines, political stories, social media opinions, and expert arguments can dominate the short run. But over the long run, the market follows the economic engine. Revenue, margins, cash flow, and the ability to grow profitably matter. If a company continues to increase revenue and improve margins over many years, the stock price eventually tends to reflect that. If a company has a beautiful story but poor economics, the story eventually breaks. This is why I do not obsess over every headline. A good investor must separate signal from noise. The signal is the business, the noise is everything that makes you forget the business. When Palantir was controversial, people had many reasons to dismiss it. They argued about valuation, they argued about government exposure, they argued about competition, they argued about whether the AI story was real. But the important question was simpler: were the revenues and margins developing in the right direction? That is the type of question that matters. Not because any single company is guaranteed to win. Nothing is guaranteed, but because fundamentals create the foundation for long-term returns. The third principle is that the best companies often look obvious only in hindsight. When the market is calm and prices are high, everyone wants the same quality companies. When the market is falling and uncertainty is high, many people suddenly do not want them anymore. That is when the opportunity can appear. But you cannot build your list in the middle of panic. You have to build it before. You have to know which companies are strong, which are merely popular, which are mission critical, which are financially fragile, which are dependent on easy money, which can survive a downturn and which might never recover. Survival is the dividing line. A company that survives a crash with its competitive position intact can come out stronger. A company that cannot survive does not matter how cheap it looks. The fourth principle is that the world does not stop. Wars happen, pandemics happen, oil shocks happen, recessions happen, debt crises happen, political shocks happen, market crashes happen. People feel like the world is ending because the present moment is emotionally intense, but the world keeps producing, companies keep trying to increase revenues and profits, entrepreneurs keep building, engineers keep improving systems, consumers keep needing products, governments keep needing infrastructure, technology keeps advancing, the stock market over long periods reflects that productive engine. Not smoothly, not comfortably, not without drawdowns, but over long periods, the companies that produce more value tend to become more valuable. That is why the long-term chart matters. The red periods are real, bear markets are real, they hurt, but historically, bull markets have been longer and larger than bear markets. The challenge is not knowing that fact intellectually. The challenge is behaving as if you know it when the screen is red and everyone is scared. That is where most people fail. They know the principle when it is easy. They abandon it when it is useful. So if the Iran shock hits and oil rises and inflation fear returns and the market sells off, the first thing to do is not to panic. The first thing is to identify what part of the machine is being affected. Is the shock raising energy costs? Is it increasing inflation expectations? Is it reducing the Fed's ability to cut? Is it pressuring consumers? Is it creating broad market weakness that drags down strong companies with weak companies? Is it creating a chance to buy companies tied to the next decade at prices created by fear rather than fundamentals? Those are the questions. Then you look at your sleeves. Energy infrastructure tied to AI and grid resilience, memory tied to AI complexity, production tied to chips, lithography, foundries, design, and connectivity. Decision systems, cloud, databases, cybersecurity, and monitoring tied to operating in chaos. Automation and productivity tied to doing more with less. Then you ask which companies in those sleeves remain fundamentally strong, not which fell the most, not which is most popular online, not which has the loudest community, which companies are best in class, mission critical, financially durable, and positioned in areas where demand may grow for years. That is the list you want ready. The framework names many of them: CG, VRT, Bloom Energy, Micron, NVIDIA, AMD, ASML, TSMC, Arkansas, Cadence, AT, Palantir, CrowdStrike, Datadog, MongoDB, Oracle, Microsoft, Google, Amazon, Tesla, Meta, SoFi, and Robinhood. This is not a command to buy them blindly. It is a map. Maps are not destinations. They help you know where you are. They help you see relationships. They help you avoid wandering emotionally through a dangerous environment. When volatility rises, the investor with a map has an advantage over the investor with a reaction, but even the map must be used with risk control. Every company has risk. Every thesis can be wrong. Every great business can be overpriced. Every market can stay irrational longer than you expect. Every investor can overestimate their own emotional strength. That is why position sizing matters. You should never own so much of one company that a normal drawdown changes your life. You should never add so aggressively that you run out of cash before the cycle finishes. You should never let excitement replace analysis. The purpose of a portfolio is not to express all your opinions. It is to survive and compound. Survival first, compounding second. That is the order. If you reverse the order, you may chase returns so aggressively that you do not survive the period required to earn them. That is what crises teach. They teach humility, they teach patience, they teach that liquidity matters, they teach that quality matters, they teach that temperament matters more than intelligence. They teach that the people who sound the most certain are often the most dangerous. They teach that the future is never one path. It is a range of probabilities. When I think about the Iran shock, I do not think this is definitely the exact event that creates the next great buying opportunity. I think this is one possible trigger in a system already full of pressure. Oil is important, inflation is important. The Fed's position is important. AI infrastructure is important, energy demand is important, semiconductor production is important, cybersecurity is important, automation is important. The specific headline may change. The system pressures remain. That is why I do not want to prepare for one news event. I want to prepare for the type of world that news event reveals. A world with higher energy needs. A world with more geopolitical instability. A world where AI infrastructure becomes more physical, not less. A world where memory, chips, cooling, power, cloud, cybersecurity, and decision systems become more essential. A world where weak companies get exposed and strong companies gain share. A world where inflation quietly destroys people who think cash alone is safety. A world where panic creates opportunity for those with discipline. That is the world I am preparing for, and the preparation is not complicated. It is not easy, but it is not complicated. Build the core. Study the sleeves. Know the companies. Watch the fundamentals. Buy slowly. Do not use leverage. Do not panic. Do not try to call the exact bottom. Do not let the news cycle control your behavior. And always remember that the market is not a voting machine over a day or a week. It is a weighing machine over time. It eventually weighs revenues, margins, profits, cash flows, and durability. The best investors are not the ones who know every headline first. They are the ones who know what matters after the headline fades. That is the difference between reacting to a crisis and using a crisis. When everyone is afraid, you do not want to be reckless. Recklessness is not courage, but you also do not want to be paralyzed. Paralysis is not prudence. You want to be calm, clear, and prepared. You want to know what you would buy if the market gave it to you at a better price. You want to know how much you would buy. You want to know how you would add if it fell further. You want to know what would make you stop buying. You want to know whether the business is still improving or whether the thesis has broken. That is what separates a system from a slogan. Buy when there is blood in the streets is not enough. You must know what to buy, why to buy it, how much to buy, and how to survive. Being early is common. Being early with no plan is dangerous. Being early with cash, patience, and a strong thesis can be very profitable. So when I look at the coming shock, I do not see only danger. I see a test of preparation. If you own poor businesses, the shock can expose them. If you use leverage, the shock can force you out. If you sit in cash forever, inflation can slowly make you poorer. If you chase oil without a plan, the cycle can trap you. If you buy weak companies simply because they are down, you can lose more than you expect. But if you own a resilient core, maintain liquidity, study the companies that sit at the center of the next decade, and add slowly when fear gives you a better price. Then the same shock that hurts unprepared investors can become a long-term opportunity. That is the paradox of investing. The same event can destroy one person and enrich another. The difference is not the event. The difference is preparation, behavior, and the quality of the assets owned. The Iran shock may come. Oil may rise, inflation may reappear, the Fed may be boxed in, the market may sell off, people may panic, the headlines may become frightening. But I have seen enough cycles to know that the world will not end simply because the market falls. The stronger companies will adapt. The essential companies will keep serving essential needs. The businesses with real demand, real margins, and real strategic importance will keep moving through the system. Your job is to know which ones they are before everyone else calms down, because when everyone is calm again, the prices are usually different. That is why the time to prepare is before the shock fully hits. Not after the market has already recovered, not after the news becomes obvious, not after the crowd decides it is safe. The crowd usually feels safe when the opportunity is smaller. The disciplined investor learns to feel clear when the crowd feels uncertain. That clarity comes from a framework, energy, memory production, decision systems, automation, core exposure, slow buying, no leverage, watch fundamentals, respect risk, survive first, compound second. That is the framework. And if you can follow it, then the coming volatility does not have to be something that simply happens to you. It can be something you are ready for.